In today's video, we're going to be taking a look at 3 stocks trading at their 52-week lows. When it comes to investing, I'm constantly on the hunt for value. Stocks that have fallen off their highs could provide for great value, but not necessarily. There are plenty of stocks out there that are pure cheap, but they're cheap for a reason. Maybe they're seeing slowing growth, or they're operating less efficiently. Whatever the reason may be, we're going to take a look at all 3 of those stocks today and determine whether they're even a buy and give you my buy price. So before we begin, do me a huge favor. Click that like button down below. Subscribe to the channel and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could check out their 10 best stocks to buy right now. All right, let's jump back into our video, taking a look at 3 stocks trading near their 52-week lows, beginning with PepsiCo, stock ticker PEP. PepsiCo is the second largest beverage company here in the world, and they trail the likes of Coca-Cola in that category. But in the US just recently, Dr. Pepper, in terms of the soda itself, surpassed Pepsi as the second most consumed soda beverage here in the US. Both of them trailing by a wide margin Coca-Cola. So with that, this consumer staple is losing ground in the race, and their stock price has been losing ground as well. Let's dive into some of the numbers right now. As you can see here, PepsiCo has a market cap of $226 billion. And over the past 12 months, the stock is down 12%. Year to date, they are down 3%. When we look at the stock price today, when it comes to PepsiCo, it first hit these levels back in November of 2021. So essentially, since that time, the stock has gone absolutely nowhere. So looking here, we can see the company has an enterprise value of $263.5 billion. Over the trailing 12 months, they generated $7.2 billion in free cash flow. That's up slightly from $7 billion back in 2021, so they've improved slightly there. EBITDA came in at $15.9 billion. That's up about $1 billion from 2021. And total debt is up to $45.9 billion. Back in 2021, that was $40.8 billion. So overall results are up slightly, but the debt is growing much faster. Now taking a look at the dividend, where you can get a juicy dividend. This has been a staple, a consumer staple for many dividend investors. Right now you can get a 3.3% dividend yield. They have a very high payout ratio, which does give me some concern. 5-year dividend growth rates at 6.5%, and they are a dividend king, having increased their dividend for more than 50 consecutive years and counting. When we take a look at guidance here, we could see that over the next 3 years, analysts are expecting only about 7.5% average annual growth in terms of EPS. When it comes to revenue, it's even slower at only 4% over the next 3 years. Now for valuation, where we could see the company has a forward PE multiple of 20.1 times. This is below the company's 5-year average of 23.4. They have an EV to EBITDA of 16.6 times compared to their 5-year average of 17.6. They have a price to free cash flow of 16.4, which compares favorably to their 5-year average of 19.2. So when we look at the multiples here, it kind of makes sense. The stock does look cheaper, but when we look back over the past few years in terms of operating results, the company's not growing all that fast, either top line or bottom line. So do they deserve a multiple that they once had back in the day? Now, the company consistently turns over solid free cash flow, but nothing is growing all that fast anymore when it comes to PepsiCo. Therefore, when I look at a price that I want to buy this particular stock, it's going to be right around $145. And this implies an 18 times multiple. So when it comes to Pepsi, I'm still looking for further downside. Even though we're trading close to our 52-week lows, I want that price even lower based on the multiple, based on the forward guidance that we're seeing before I dip my toes into PEP. Now let's move on to stock number 2, which is McDonald's Corporation, stock ticker MCD. Many of you think of McDonald's as a burger chain. I think of McDonald's as a real estate company. After all, they own the building and the land, and they charge rent to the franchisees. Remember, McDonald's is a franchise model. The franchisees rent the building space, which is owned by McDonald's Corporation. Taking a look here, you can see the company has a market cap of $181 billion. Over the past 12 months, shares are down 15%, which is in line with their year-to-date results as well, now having the stock trading very close to their 52-week lows. Taking a look here at the numbers, we could see the company has an enterprise value of $231 billion. They have free cash flow of $7.2 billion, which is up just slightly in the past few years. EBITDA came in at $14.1 billion, which dating back to 2021, that was $12.2. So a nice little increase there over the past few years. And then total debt has upticked just slightly from $49.3 billion in 2021 to $50.8 billion over the trailing 12 months. Taking a look here at the dividend, you could see that the company pays a 2.7% dividend yield, a payout ratio of 53%, and a 5-year dividend growth rate of about 7.8%. The dividend growth number there from Seeking Alpha is incorrect. In fact, the company has paid a growing dividend for more than 40 consecutive years and counting now. Now for guidance, where we can see analysts are expecting a 3-year average EPS growth rate of 6.4% per year, and when it comes to revenues, closer to 5.5%. So again, another company that is seeing slowing growth. However, when you do take a closer look here, growth is expected to slow here in 2024, but then pick back up in 25 and 26. So you could be buying now for future growth. Let's take a closer look at valuation, where we could see the company has a forward PE multiple of 20.5 times, even lower if we use the 2025 earnings. They have a 5-year average of 25.2, so a nice little discount right now. EV to EBITDA is close to 16.6, 5-year average is 20.4. And when we take a look at price to free cash flow, shares are trading at 8.6 times compared to 22.3 times over the past 5 years. So a pretty sizable discount across all 3 metrics that we're looking at here today. So again, when it comes to McDonald's, again, a real estate company, almost a recession-proof like business here. They'll see slowdowns every once in a while as consumers weaken, but consumers are going to trade down to the likes of McDonald's when budgets get tight. So there's always constantly going to be money coming through the door here. But when it comes to my buy price, I'm going to continue to be patient, but out of the 3 stocks that we're looking at today, this is the one I'm most upbeat about. So McDonald's right now is trading closer to about $250 per share, another $15 decrease in the share price, I would be happy to add to my position again. This is again a position I already own. So at $235, I would love to buy here. Again, implying an 18 times multiple, very similar to what we just looked at when it came to PepsiCo. So 2 companies with eerily similar valuation metrics. I'm just a little bit higher on the likes of McDonald's over PepsiCo. And that leads us to stock number 3, which is BristolMyers Squibb, stock ticker BMY. And BristolMyers is a stock that I've held over the years and one that has been quite frustrating. This stock has been hammered. They are a pharmaceutical company that has made a lot of headway, but they've done it a lot through acquisitions. And I believe this is a company that needs yet another acquisition to spark up some growth. But shares are extremely cheap right now. As you can see here, the company has a market cap of $80 billion. And over the past 12 months, I wasn't lying when I said this stock has got hit pretty hard as they are down 39%. So far in 2024, the pain has continued as the stock is down 23%. Taking a look here at the figures, you could see the company has an enterprise value of $129 billion. That implies right there that they have a lot of debt and not much cash, because when we look back, you could see the company had a market cap of $80 billion. Now an enterprise value, which adds debt into the equation, less the cash, we're talking about $129 billion. The company generated free cash flow over the trailing 12 months of about $12.5 billion. That is down from $15.2 billion back in 2021. EBITDA came in at $5.3 billion, well below their 2021 figures of $20.1 billion, and total debt has continued to increase, up from $45.6 billion, now sitting at $57.4 billion. So not a great combination there. We have less free cash flow coming in the door, a whole heck of a lot less in terms of free cash flow, and our debt is increasing. Why has this happened? Well, they've seen a lot of their mainstream drugs that account for over 60% of their revenues, lose patent protection. But they do have some up and coming ones that are going to change all of this. And you're going to see this based on the guidance figures here in a second. However, before we get to guidance, let's take a look at the dividend. This is going to be the highest dividend yield out of the 3 stocks we're taking a look at today. You could see the company pays an annual dividend of $2.40, which equates to a dividend yield of 6%. Looking at that payout ratio on the screen may be a little misleading though, because what we want to look at more closely is free cash flow payout ratio. And the company is generating free cash flow of about $6 per share. So when they pay a dividend of $2.40 and we divide that by 6, the payout ratio is actually closer to 40%, meaning that this one is not right now in danger of being cut. And they have a 5-year dividend growth rate of 7.7%. Now let's take a look at guidance, where things don't look all that great. As I noted, the company lost patent protection on some primary drugs in their portfolio, which is why we see the big drop-off in EPS. However, there's a lot more coming online in the next 12 months or so, which is why we see the big spike. However, that $6.92 that you see in December for 2025 is still below where the company was in 2023. It's below where they were in 2022. Below where they were in 2021, it's higher than 2020 though. So the company is pretty much reverting back to where they were over 4 years ago. Revenues aren't that great either, but that probably makes sense. It's going to be kind of the same story from that standpoint. So let's take a closer look at valuation, where we can see forward PE multiple of 5.7 times. This is a company that historically trades at a low multiple, but one that's closer to 9, not closer to 5.5. In terms of EV to EBITDA, we saw the company EBITDA drop off, so it makes sense that it's a high EBITDA multiple right now at 23.9 compared to a 5-year average of 11.8. Doesn't look all that intriguing. However, those are going to bounce back here. Price to free cash flow at 5.8, historically closer to 10 times. So when it comes to the multiples, the valuations are all over the map. It's hard to get a good reading. And the sense that I take here when it comes to Bristol-Myers is we have seen this stock price get hammered. So a lot of the bad news is priced in. But at the same time, this is a company that has to prove themselves. They have a lot of proven drugs that are now coming offline, and they have a lot of unproven drugs that are coming online. So this is a case where you do not want to catch a falling knife. Rather, you would rather jump in after the stock has turned around, albeit a little bit, and see some of those proven results. So when we look at my buy price, where am I going to be comfortable buying shares of BMY? It's going to be closer to those mid to low 30s. So that's still implying a multiple of just 5 times. Again, a lot of that weakness is already priced in, but I still want to see some sort of turnaround at that point there. So now we just looked at 3 stocks trading at or near 52-week lows. The one I'm most high on out of the 3 is McDonald's. In the comments section down below, let me know which of these 3 stocks, if any, would you be interested in owning and at what price? And if you haven't done so yet, make sure you smash that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.